All right, class, here's exercise 2. The second year gets a little more complicated each year as things happen and as time goes by. Again, we start with income before taxes. We got the tax return here. We've got the income statement. We've got two permanent differences this time. Municipal bond interest and life insurance. So both of those are permanent differences. One is a subtraction, meaning that it's not taxable, so it's not included in our income on the tax return. And the other is an expense that is not deductible, so we have to add that back. And so we get a subtotal of 296 with just the permanent differences. Then we have our temporary differences. Now, one of them is the bad debts. This is the allowance for bad debts account, what it should look like. Remember, last exercise 1, we ended with a allowance of $8,500. That was the difference last year. This year, we estimate the allowance here, that's the credit, and we write off accounts here, that's the debit. So our ending balance is $25,200. So what do we do here? We take, because we need to know what the difference is, the estimate is what's on the income statement, the write-off's what goes on the tax return. So the difference between these two, $16,700, is what we're going to put here in our column, because that's how much different the tax return is from what we calculate on the income statement. However, the remaining allowance is $25,200. So when we get to our calculation of the tax asset and liability, that's we'll need to look at that. Then a new situation with having to do with unearned revenue, unearned rent. That has to be put on the tax return even though it hasn't been earned, because that's the tax law. When you get it, you pay tax on it. So that needs to be added here. There's no difference from the year before, and so that's fairly straightforward there. Depreciation, I separated the 2018 equipment from the 2019 equipment just to make it easier to see. So here on the 2000, the difference is, like we said, on depreciation. If you depreciate it all in the tax return in the first year, you can't depreciate it in future years. So in year 2 of this depreciation, the depreciation on the income statement is $87.86, and there's no depreciation on the tax return. So you have to add back that depreciation to get our taxable income. For 2019, we have some new equipment purchased. Again, we depreciate it using straight line 5 years, half-year convention. The difference, we're going to depreciate the whole thing on the tax return, so the difference goes in our column between the amount we paid and how much depreciation we're going to take on the income statement. 6467, again, that's higher depreciation on the tax return, so we subtract it. Finally, our taxable income is $326,719. We come over here and we do the same thing as we did before. We take that number and multiply it by the tax rate and get our tax expense and taxes payable. Journal entry number 1. Then if we consider each of our temporary differences separately, so we go back to bad debts, we figure out that we have a allowance of $25,200, which gives us a deferred tax asset of $52.92. We know that our deferred tax asset last year was what? $17.85. So we need to make a journal entry for the difference, which is the $35.07. That's the difference between our deferred tax asset for this year and the one from last year. having to do with bad debts. All right. Then we can look at the $11,000 unearned revenue. Since it's going the same direction as an addition, you can see that it's also going to be a deferred tax asset. So you just take that because there's nothing from the year before. You don't have to compare it. You just multiply it by the tax rate and make a journal entry. Both of those are going to increase the asset. Now the liability, the depreciation can be treated together or separately depending on what you want to do. But I did a little schedule that shows the accumulated difference between the depreciation for tax purposes. Okay, so here's what depreciation on the 2018 equipment for tax purposes. Here it is for 2019 for tax purposes. This is what we did for this year for 2019 and 2 years to combine for 2018. So the difference is 48,321 for this year, and then of course the 2019 64,67 for a total difference of 54,788. So literally you brailled yourself a spreadsheet and show the difference between their accumulated depreciation. That means that we need a tax liability of 11,505. Our liability from last year, 11,993. So the difference, we need to make that liability go down by 487. Okay? And if we make the liability go down, we need to credit the expense. So our deferred tax, our tax expense is this journal entry amount minus this, minus this, minus this, 62,307. All right, and finally that will be subtract that, get our net income. And of course, the current amount and the deferred, three amounts together. Your reconciliation of the effective tax rate. All right, we at 62,307, that ends up with a 20% rate. It should be 21. The municipal interest made a difference of 54.25. The life insurance 882, which actually rounds to 0, but this is really 2 and then part of 1. So that often when you round off, you don't get exactly the amount you expected. But this is what our tax expense would have been at the 21% rate. So we reconcile what the law says with what we actually paid based on our two permanent differences. And given the small amount of the life insurance permanent difference, you probably could just put those together as one permanent difference in your disclosures.